Good afternoon, everyone, or good morning, depending upon where you're joining from. We're really glad to have you here today. The topic today is maximizing profitability with effective budgeting, and we're joined by Robert Jones with Left Brain Professionals. My name is Liz Brigson. It's a pleasure to be your host today, and there's just a couple things I'd like to point out to help you get the most out of the presentation. So hopefully you've had a chance to be following along. Robert has been with us for quite a long time, presenting monthly webinars and sometimes even webinars twice a month. So welcome back, and if you're new here, these things will be important for you to hear. So we like to use the GoToWebinar questions pane for live interaction. So if you go to the GoToWebinar panel, you can find the questions box, drop it out, and go ahead and say hi. Let us know where you're joining from, and maybe just say, like, how do you feel about budgeting? Thumbs up, thumbs down. We'd love to hear from you. We have the handouts for the presentation today. You can download either from the GoToWebinar control panel or from your in-Course dashboard. The presentation today is an hour and a half, so that means we will have 7 polling questions, and you will want to respond to a minimum of 6 of those 7 polling questions to earn your CPE credit. You'll be able to access your CPE certificate from your in-Course dashboard an hour after the program ends. And if you have any questions about CPE, go ahead and let us know. Well, it's a pleasure to welcome back Robert Jones with Left Brain Professionals. This is a topic, it looks like we have a thumbs up from Gwendolyn. We have Vicki, who's new to budgeting, so doesn't have an opinion yet, but hopefully you'll have one here soon. Christine from Austin, Texas, loves budgeting. Says it can be super powerful. Keela says it's interesting. This is really fun to read. Lisa says it's a gray area. It's not cut and dry like traditional accounting. I really love that about budgeting. Cynthia says it's rewarding. So Robert, you have an audience who is actually pretty pumped up about budgeting today. So I'm excited about that. Robert is government contracts and accounting expert for Left Brain Professionals. He's the founder of LBP, and he has a master's in accountancy from the College of Charleston. He has held a whole bunch of roles that really bring him a lot of expertise in the subjects of government compliance and budgeting. As you can see here, he's been a controller, a defense contracts manager. He's an instructor and a speaker, and soon to be a conference organizing pro. So Robert, thanks so much for being here today. I will turn things over to you, and I think we have an audience who's really revved up and ready to dive into budgeting.
All right, well, thank you, Liz. Again, always good to be back here with the in-Course platform. And I think I agree with a few of the attendees that budgeting is, for me, and I guess it's because I'm an accounting nerd, and I guess we have some other accounting nerds here with us. I think budgeting is kind of fun. Certainly, what's interesting is that when you deal, and I found this across the board, whether it's government contractors or commercial businesses, that when people say budgeting, it kind of comes with a big groan, like when people say, oh, I got to do my taxes, right? And and honestly, budgeting doesn't have to be that way. I think that budgeting does come with the big groan because of probably some bad practices that occur in many companies. And I'll talk about some of those best practices with some tips and tricks kind of near the end of the presentation. But what I'll preface with and kind of give you a little bit of a spoiler is, this really isn't just for the accounting department. It's not just for the accountants, or maybe even in a small business, the single accountant that might be working, right? That budgets really, to be effective, to be the best budgets, really are a team effort, and it's more than, again, it's more than just the accounting team that's involved with it. All right, a little bit about us. Again, my name is Robert Jones. The firm is Left Brain Professionals. We are a boutique accounting firm that works only with government contractors. We specialize in accounting system design, implementation, and audit support. We do a lot of work with clients around, setting up their accounting system, helping them get through the SF 1408 survey, which, by the way, we have a 100% success rate with DCA audits and getting our clients approved accounting systems, and we just got another one on the books in the last couple of weeks. We also do a lot of work with indirect rates, strategic pricing, and really that's where today's topic of budgeting comes into play. Is budgeting is this forward-looking process, and we need this forward-looking process to develop our proposal rates and our billing rates that we're going to use on our government contracts. Now, for those of you, and I'm sure that many of you have probably been on our webinars before, and again, we are here talking primarily about government contracts and contractors, but I will say that, a lot of what we're going to talk about from a budgeting perspective really applies across the board. There's not necessarily anything unique in that perspective, but certainly you're going to hear me talk about some of the unique issues for government contractors, particularly as it relates to those indirect rate structures. A couple of my other colleagues, so we are a growing firm, which is exciting. It's a busy time for us. We've onboarded new clients, and as Liz said, we have an upcoming conference, and I'll be sharing details with that at the end of today's presentation. Our learning objectives at the end of our time together today, you should be able to describe the top-down and the bottom-up methods of budgeting, explain the role of historical trend analysis as it relates to budgeting, describe the reasons for and the timing of budget adjustments, and list some budgeting best practices. With that, let's go ahead and kick off this first polling question, please.
All right, that sounds good. So our first polling question is, how confident are you in developing a budget? So it'll be fun based upon the initial audience feedback around your feelings toward budgeting. It'll be interesting to see how the results come in. I want to also let you know that we have Jenny from Left Brain Professionals on the line with us. Jenny is going to be monitoring for Q&A, and she'll be helping us to facilitate Q&A at the end and possibly throughout the webinar today. So this is your reminder that if you have questions as we go through the material today, please type your questions in the questions box, and we'll make sure to note those down. All right, awesome. Robert, we have 95% of the audience that's submitted, so everyone's very eager to let us know how they feel about budgeting. And here we're seeing 44%, almost half of the audience says pretty confident tips would be helpful. A third of our guests today say they're fairly knowledgeable but could use review. And isn't that the case? I feel like being knowledgeable about budgets and budgeting is awesome, but there's always tips and there's always just opportunities to refresh and review. We have almost 10% of the audience that is totally on top of this, masters of budgeting, and 14% who say they're not confident at all yet. And I know that we have some people here who are new to budgeting, so I'm excited that this gets to be your introduction. So thank you everyone for those responses.
All right, let's dive into our content here. We're going to kick off with the methods of budgeting and with a little bit of background here. So budgets are a critical step in developing proposal and billing rates. Again, primarily here talking about government contractors, but I'll pause for a moment and say, this is an interesting area for commercial contractors, and it's really a conversation that oftentimes happens when we have new clients come to us who have a large or maybe historically have been only or primarily a commercial contractor, right? Not selling to the government. And now they start selling to the government and they're dealing with this new layer of rules and regulations that come with those government contracts. And again, as a firm, that's what our expertise is helping clients with that. That said, again, sometimes what happens is companies come, they start doing business with the government, and they say, well, these new rules and these new practices don't necessarily make sense to us. Like, why are we doing this? And what I tell people is, yeah, it is different. It's new to you. There is a reason for it. And actually, if you just give it a try for a little bit, I think you're going to realize that it really brings value to your overall business and not just your government contracts. And I can say that by and large, most of those people do see that, right? They realize that, hey, when I do understand my total costs and I do understand my rates better, then I'm developing better prices, right? That's one of the things that, again, for those of you who've been with me, you've heard me say, one of the very common, probably one of the most common things that we hear from clients or potential clients is they'll say, we're just not making as much money as we should, right? Something doesn't seem right and I don't know why. And really it's 99 times out of 100 when I hear that, I know the answer is lying somewhere in the indirect rates. They don't have the correct structure, they don't have the proper composition of the pools and the bases. And when those things are wrong, then your prices are wrong. And, and again, 99 times out of 100, it's not that you're overpricing the customer, it's that you're underpricing the customer, right? And you're eating into your profit margins because of those errors. And again, and that's why budgets really are critical. That's why they're going to be that step for success for you. Again, I think one of the reasons that people think negatively of budgets is they feel like, oh, it's a restraint, right? Because when we talk about budgets and we talk about spending, we're usually prepared to hear, no, not going to spend that money. No, can't approve that. And it's not that budgets have to be a constraint. It's really that, for me, they're a target for success and profitability, right? The old adage of planning for success? To me, that translates into budgeting for success. And the last kind of preliminary point here is, remember, we can always make adjustments. And again, we've got a specific section to talk about what those kinds of adjustments are and when and how we make those adjustments to our budgets. All right, let's talk about this first method of budgeting. This is what I call the top-down approach, and this is the revenue-based forward-looking, okay? That means really it's three things that come into that. The first is the backlog. That's your list of known or committed work, right? So pretty much every business, we have a list of orders on the books right now that we know we got to deliver that work, whether that's delivering a product or delivering a service or some combination. We've got orders in-house and we know we've got to deliver that work. Now that's going to vary, the size of that backlog, right? And as a percentage of revenue is going to vary from company to company and industry to industry. I will tell you that one of my previous employers, for us at that time, our average and certainly our target backlog was around 18 months. And you might say, wow, that's pretty amazing. The nature of the work that we were doing, the product that we were delivering, our build time on a lot of that product was somewhere around 9 to 12 months. The development effort on those development type contracts, those could easily be a year or more. And now we certainly had, some projects and some products that were, measured more in weeks. But overall, for us, having about an 18-month backlog was a pretty good target, right? And we knew that, hey, if that backlog is closer to 12 months, then right, we've got a problem. We've got a sales issue that we need to address. So here, what you want to do is pull that backlog and see, if I'm putting together the budget for my next fiscal year, what backlog is on the books and what is the timing, right, and the dollar value. What do I need to do for that? The second item are those pending proposals that are out there. And this is where you need to apply some kind of weighted analysis and say, and this is probably, and this is one of those areas, one, I would say the overall top-down budgets is definitely not an accounting only situation, right? If I were to weight this, I would say this approach is probably 70 to 80%, someone in business development, program management, whoever that is in your organization. Certainly the accountants are involved in validating some numbers, because we can hopefully validate the backlog that's out there. But certainly number two here for pending proposals, right? That's got to be somebody in business development, program management who can say, hey, we've got 5 or 10 or however many outstanding proposals for the budget time period in question. And then they need to be able to look at that on a proposal by proposal basis and say, okay, this one we have a 25% chance of winning. This one is 50% or 70% or whatever those numbers are. You multiply that percentage times the dollar value so that you then end up with a weighted analysis. So let's say, for example, that across those, I'm going to use 5. So let's say I've got 5 proposals and maybe combined they equal $10 million. and I go through, and I do some analysis on those, and I say, okay, of that $10 million of proposals that are pending, when I do my analysis, I come up with, let's say, $6 million that I think, we're probably going to win about $6 million. So I'm going to take that and add to number one, whatever my existing backlog is for number one. Let me pause and back up for a moment and just clarify something on backlog. Now, certainly, hopefully, you're keeping on top of the schedule and the backlog overall. But I would say from a budgeting perspective, when you're looking at the backlog, this is definitely the time to make sure that the schedule and the dollars are up to date and accurate on that backlog, right? Did we have any schedule changes that have been, requested or otherwise approved by the customer that would affect when we're going to deliver, right? Did something get pushed out? Did something get pulled in? Whatever the case may be, you're going to want to make sure that those dollars and the timeline for those dollars is accurate. Our pending proposals, obviously, it's going to be the same thing, right? Many times in many industries, we have work that spans fiscal years, so we want to make sure that we're only looking at the dollars that are in the fiscal year that we're budgeting. So let's say, for example, my backlog, I go back to my previous employer. If I had a backlog that on average was 18 months, and I'm putting together, a budget, well, I need to look at what is actually occurring in that 12-month period, for my budget period. So just keep that in mind. Same thing is going to be true, with your pending proposals here. And then the third piece from this revenue-based or forward-looking is what I call the other filler work. This is that regular but unidentifiable work, right? So we all know that we have some amount of work that, kind of generally shows up. It's something that, we don't really have proposals for, or it's proposals that we can't necessarily predict, but we know on average, hey, whatever that is for your company and your size, right? It might be $100,000, maybe it's $1 million, right? You know that there's other work that always comes in, even though you can't exactly predict what it is or when it will happen, right? So those would be the three big pieces of data that you need from this top-down approach. Then what you're going to do is transition, and you're going to say, okay, what are the direct costs or the cost of goods sold? And remember, for government contractors, we use the term direct cost, which really is just another name for cost of goods sold. And here what I need to know, what are the costs that are necessary to support that billable work? And I need to look at that in terms of my 5 cost elements, right? So labor, material, travel, ODCs, and subcontractors, right? So what I got to do is, what is it going to take me in terms of cost for these 5 cost elements to be able to deliver all of that work that I previously identified on that last slide? Again, this is going to be, somebody from a program management kind of perspective, right? They're going to know, hey, in order for me to do these specific types of work, I'm going to need this number of employees, this number of hours. I'm going to have to buy this kind of material. We're going to sub out, X portion of the work, all of those types of things. Because then I'm going to, right, that tells me this is the money I absolutely have to spend in order to deliver that work, okay? Then what we're going to do is shift gears, and actually not even so much shift gears. At the same time, you're going to see where all this comes together. You also need to be looking at a bottom-up budget. Now, this is where I would say the accountants are involved. And in fact, if I were going to put a percentage, this is probably where the accountants are doing probably 80% of the work, maybe, and and 20% is somebody else. And you'll see kind of how this makes sense here. So the bottoms ups is more historical and expense based, right? So we're looking at what did we spend last year and what's our average, right? What, looking at some of those trend analysis that we'll talk about. But this is where I'm going to pull actuals from the previous years and look at, okay, based upon this kind of information, what do I expect my expenses to be for the years? Our bottoms-up budget are primarily indirect costs, though we'll talk in a moment about how we marry the direct costs from a historical perspective to the proposed cost in just a moment. This is also, again, from the bottom-up historical approach. This tends to be more fixed or known costs. And so things like fringe, right? We know, for example, how much it costs, right? For health insurance. We know what our 401k costs are. We know, even though it's a percentage, things like employer taxes, we know that based upon a certain dollar amount of labor costs, we can easily predict these other costs. Similar for overhead, right? In my overhead, I know that I'm going to have rent, utilities, some maintenance, repairs, other kinds of things like that. And while some people might say, well, but my utility bill goes up and down, and my maintenance and repair costs may go up or down. That's true. But over time, we generally have a fairly good sense of what those are, right? We can get an average of what utility bills are. We can get an average of maintenance and repair costs. And in fact, on many of those maintenance and repair costs, we oftentimes have static fixed costs, right? Because we've got a contract with an outside company, right? We've got somebody that we know, hey, lawn and parking lot maintenance is, $2,000 a month or whatever that is, right? Again, we know what our rent is. We know what our insurance costs are. For our G&A, and let me pause here for a moment as a quick reminder for people, and maybe as an intro for those who maybe aren't, who are new to government contracts in our conversation today. When we talk about, and actually when we talk about fringe, overhead, and G&A, we're talking about indirect costs. In the commercial world, we oftentimes just say kind of overhead as a generic all other costs besides direct costs. Some companies talk about overhead and SG&A, or selling general and administrative costs. In the government world, we talk about fringe, overhead, and G&A. Notice that it doesn't include the S for the selling portion, because there are some selling expenses that are unallowable. A whole other conversation. Specifically here, talking about overhead and G&A. Quick reminder is that overhead are those costs that are necessary to support customers, clients, projects, products, services as a whole, or otherwise costs that I'm incurring to support multiple customers or multiple products or services where I cannot easily identify those costs down to a single end item, okay? G&A, on the other hand, are the costs to run the business as a whole. The G&A types of expenses are things like accounting, business development, HR, IT. These are costs that I say you would incur whether you had 0 customers, 1 customer, or 100 customers. You're going to spend those kinds of expenses, right, in order to, again, run the business as a whole. And then what we really do, and this is what I really refer to as budgets, and it's hybrid budgeting. It's where we marry those top-down and the bottom-up versions, right? So, from the top down, if I've got sales and business development looking at a revenue perspective and saying, this is where, we think we're going to be from a revenue perspective. I've got the program people saying, okay, in order to meet that kind of revenue, we're going to incur these kinds of direct costs to do that. Again, that's, my rough numbers, maybe that's 80% sales, program management, business development kind of people, 20% accounting. And then at the same time, the accountants have kind of flipped that, and they're doing, maybe 80% of the work on the bottom up portion, and 20% or so, maybe they're sharing with budget owners to get them to say, this is where we were in the past. Does this look like where you think you're going to be, for the next year? Are there things that you need to incorporate, right? Because obviously budget time is where people start putting in their wish list. Hey, we need to get new computers, or we need a new press, or we need, some type of new equipment or vehicles or whatever that is, right? So they're putting in their Christmas list for stuff for the budget, right? That's where some of those other people are involved. We're giving them the historical stuff, and then we got to get together and pull all of this information together and marry it up. And then specifically what we want to do is we want to identify the gap between the historical costs and what I define as the necessary COGS or direct costs, right, to support that work, right? Because there's going to be a difference. Because what's going to happen is, for example, when we look at the direct or the COGS portion, your program people might come back and say, hey, in order to do all this work, I need the equivalent of 20 full-time employees. And your historical work might show, well, hey, we've only had 17 full-time employees last year. So that's where we then need to start making decisions. Does that mean we hire 3 full-time employees? Do we utilize are we going to maybe do overtime to cover that? Are we going to use temporary workers? Are we going to use subcontractors, right? What is that difference between what's listed and how are we going to fill it? And then also with that, right, what are going to be the costs that flow to other parts of the budget? So for example, back to my example here, that a program said, hey, we need 20 full-time equivalents to deliver this work. And you say, well, we've only had 17. Okay, those 3 FTEs, are we going to hire people? Because then what's the impact going to be on my fringe costs, right? I'm going to have health insurance and 401k and paid absences. I'm also going to have obviously my employer taxes and stuff like that. Or do we say, you know what, we think we can absorb those 3 FTEs by doing overtime? That still comes at a cost, right? So even though I'm not hiring people, I'm going to have to pay an overtime premium to do that, right? And that might be as well part of the organization's decision point, is to say, okay, what's the cost to do 3 FTEs at overtime? I don't have the hiring expenses themselves, right? Because it does cost money to, do sourcing and background checks, to do training, to do all the onboarding, right? And we can't ignore those kinds of costs. I'm going to have health insurance and those 401ks and the other stuff that we talked about. But, if I'm going to do overtime, right? Well, wait a minute, I've got not just the direct cost, but I very likely, and it depends, right? Are these exempt or non-exempt employees? I may have overtime premium. And if it is like hourly employees, I'm definitely going to have extra cost in terms of labor. But that extra cost also comes with additional 401k matching. It comes with additional employer taxes. And I've got a little cheat sheet that I'll show you at the end of kind of how to work through this. But those are the types of things that we're looking at from a budget perspective. The other gap that we need to identify is, okay, what is the gap between some other costs that we might need from an indirect expense perspective, right? So we're pulling together the historical, we being the accountants, but part of what program management and some other people and the budget managers out there, your department managers have to say is, okay, in order for us to do this work, we also need to buy an additional piece of equipment, right? Or, we're going to have to accelerate when we replace something because we've got additional work, which means that existing piece of equipment is it's definitely going to fail or more likely to fail sooner, right? Because we're going to be taxing it more. So we also have to keep in mind that bringing on additional direct work, not only in terms of employees, but brings on other additional indirect expenses, right? And again, we might have to rent a facility. We may have to buy, additional hand tools or again, whatever those other things are to support that work that wouldn't be direct expenses. So hopefully you're beginning to see here how what I said in the opening, that this is not just an accounting role, right? That this really is a team effort, and it's a team effort across the enterprise where we get together. Carrying on with hybrid budgets, and I've talked about some of this already, but hiring employees, those additional fringe costs, overhead. Some other things to keep in mind is, if I'm hiring employees, right, I may have to buy more. I may have to buy more computers, right? They're going to use more supplies. Maybe the nature. So one of our employees, the nature of the work that they do is all field work, and so they buy cars in the business, They have vehicles in the business that employees drive because the employee has to drive to do these field evaluations at all of these construction sites. So guess what? If I've got more work and I need to hire 3 employees, I'm going to have to buy 3 cars as well. And in fact, this particular client came to me the other day with kind of a similar situation and said, hey, wait a minute, we're looking at next year, we're going to have to do additional work. That also means we have to buy this additional surveying equipment, right? There's equipment that we actually use out in the field for what we do. So there are other expenses that we need to be able to think about. In terms of G&A, now again, this is a rough general guidance, but I would say that typically we would expect a fair amount of G&A to remain unchanged. Notice that the "un" is underlined there. I'm saying that, for G&A, usually most businesses can take on additional work and not have to hire another accountant. We don't necessarily have to hire, somebody else in HR, as an example, right? We can usually continue to do those things to run the business without a significant increase in additional cost. Now, obviously some exceptions there are things like, business insurance, right? So a lot of times, our business insurance is, and especially things like errors and omissions and liability insurance, product liability insurance, and some other stuff is tied to our revenue. So if our revenue is going up, right, I've got more direct work and my revenue is going up, then I can expect some of those G&A types of insurance and maybe some other kinds of expenses to go up. But probably I may not have to hire more accountants. I may not need anybody else in the IT department, right? So I would expect G&A to hopefully remain largely unchanged. And then the nice thing about that, as we've talked about with rates in general in the past, is that the more direct work that I can do, my indirect expenses, fringe, overhead, and G&A, as a percentage, right, my rate tends to come down because the base, right, that bottom number, the denominator in my calculation for those indirect pools is primarily or largely direct costs. So if I've got a larger direct base, my indirect rates are coming down over time. All right, a great poll-in question here, please.
All right, we'll get the second poll launched. And Jenny, do you see any questions that we can take?
Yes, there's actually a question in the box right now. What is ODC?
All right, so sorry, ODCs are other direct costs. And for government contractors, that is a situation where, again, if we go back and look at those 5 cost elements, I said we have labor, material, travel, ODCs, and subcontractors. So ODCs are really nominal other expenses that don't fit in one of the other 4 categories. Some examples include things like maybe some installation supplies, printing materials, or something like that, that are, again, these are direct related costs. So this is not, like printing costs in the business, but for example, we have some clients that do construction or architect kind of work. And so they have printing costs, right, in order to print out these large blueprints. That's a direct cost, and if they may categorize it in there. Again, another great example is we have a client that manufactures high-end electronic equipment. They then ship that to the customer, and then they travel to the customer to install it. And they know that when they get there, then invariably, they're going to need some other stuff, right? They might need some shims. They might need, they might get there and realize, hey, the extension cords and the stuff that we have aren't sufficient, right? We need some other kinds of things in order to install this, so that it works correctly. And so we kind of know some of those little things, but we can't predict them exactly up front. And those types of things typically fall into ODCs.
Well, we're ready to close the poll down, and thank you everyone for submitting your responses.
All right, and the correct answer here, again, when we're talking about revenue-based or forward-looking, I said that's that top-down approach, right? Top-down revenue. All right, carrying on with our content here, let's talk about historical trend analysis and how it comes into play. we need to be able to track our rates over time, right? And again, hopefully maybe some commercial people who are on the line, maybe you'll take this idea and float it back to people in your company. My government contractor colleagues out there, right? We're used to calculating indirect rates, and so we need to track those rates over time. And we also need to research the variances, right? What happened? Rates are never going to be exactly the same year to year. And in fact, when we work with a client and they show me that their rates haven't changed over time, I'm like, there's a problem. And usually what we discover is somebody calculated the rates one time 3, 4, 5 years ago, and they went with those rates and they've just continued to use those rates. They've never gone back and calculated actuals or updated them, right? And that's a problem. We know rates are going to change over time, and that's okay. But we need to be able to say, is there a general trend? Are there any significant variances? Do I know what those variances are, right? What caused it? Why did it go up at that time, right? Is it something that I can explain? Because remember, your customers, auditors, cost and price analysts out there, other people are going to see these rates depending on the types of contracts that you do. And they're going to ask questions, right? They're going to say, hey, wait a minute, especially if you're doing cost type work and you're submitting those fringe overhead and G&A rates, as part of your proposals and in your billing rates, somebody on the other end, and usually several somebodies on the other end are going to see that, and they're going to say, hey, wait a minute, your fringe rate the last 3 years was 30%, or maybe it was 30 to 32% for the last 3 years. Now all of a sudden it's 39%, right? Why is there such a big change this year? And again, there might be a valid reason for it. You might say, we had a significant increase in healthcare costs, or we changed our 401k plan, or we added additional benefits so that we could continue to attract and retain employees, right? As long as you can show and say, we know this changed, this is why it changed, and we validated the math, right? That should be one of the other things that trend analysis is for, is to say, hey, wait a minute, there's something different here. Did I actually do the math correct, right? And oftentimes that's kind of my first go-to, is to say, wait a minute, did I miss an account? Did I screw up something in my composition of the pool or in my math calculation? Because that's usually an easy validation up front. So if I can validate that and say, yep, my formula is correct, my math is correct, I'm okay with that, then I go in and then I start looking at line items. And again, it might be something where we say, hey, and again, we see this oftentimes, especially with some small contractors and small clients, that as they grow, again, they begin to add more benefits, again, to attract and retain employees. Well, what's going to happen, right? My fringe costs are going up, which means my fringe pool is going up. So as my pool, or the numerator, that top number, is going up, then my rate is going to go up over time. It's not a bad thing, but I can explain what happened and why. And then the other thing is, hopefully you've got some target rates, right? And so it's, where do we want to be and how do we get there? And let me give you kind of, I guess, probably one primary example comes to mind. And this is where we do a lot of work with our clients. So I said, we do a lot of work with indirect rates and strategic pricing. So we have clients who come to us and they say, maybe not only are we losing money, but they might say, we know we're not necessarily losing money on the work that we're doing, but we're not winning some of the contracts that we're proposing because we're just not competitive. Our rates are not in line with with our competitors out there. Another example, again, we see this in certain industries where prices are sometimes set by the prime. The prime says, hey, this is the price we pay. We don't negotiate. This is all we're going to pay. This is what we included in our proposal, right, when we rolled it up to the government. So we're not going to pay you anything different. And so what happens is the contractor or the subcontractor in this situation ends up in this squeeze. And the squeeze is, I've got to hire, I've got to be able to attract and retain employees. So I've got to pay the appropriate wage for the skills, for the knowledge, for the experience, and I got to pay enough so that they stick around. But when I do that and I add on my current fringe, overhead, and G&A and my desired profit, then that rate is actually more than what the prime is saying they'll pay me. So I'm eating into my proposed profit in order to be able to meet that, right? So I'm not making as much money on those types of things. So what do? That's where we come in and say, let's develop a strategy, right? We develop those targeted rates, and then we work with the client to figure out what do we do to get there, right? Again, mathematically, one of the easiest things to do is to get more direct work, but that's not always easy to just say, well, let me magically drum up some new work, right? I mean, we'd love to be able to do that. And sometimes companies are able to do it, but sometimes that's also, that's the chicken and egg situation where they go, but the current rates I have are not attractive to some of my customers, so I'm not doing the work. In fact, we've got a client right now that we're doing a different client that we're doing some indirect rate work with, and we're helping them build a material and subcontract handling pool and rate for those materials and subcontracts that they're essentially passing through and just managing on behalf of their government contractor. And so in our strategy and rate analysis, I said, hey, if we got you guys a lower material and subcontract handling rate, could you get more of that work, right? Would your clients source more of that material and subcontract through you? And they said, absolutely, without a doubt. And they said, in fact, the client has been bugging us and said, we want to buy more stuff from you, but your rate is really preventing us from doing it. So that's where we, again, develop those target rates, right? And so what we do is we say, okay, this is where we are, this is where we want to be, what's it going to take for us to get there? And then when we put in the budgets, right, we look to see, are we trending in the right direction towards those target rates? All right, another quick polling question here, please.
Sounds good. The third polling question is, what is part of the historical trend analysis? And Robert, you brought up a good point that I wanted to follow up on. So you said, like, talking with a client, you heard the feedback that their client was hesitating to procure more from that contractor because their rates were preventative. Who do you find is the best person to have those conversations with the client? Like, who at the company is having those conversations with their customer to really learn that information, because it's valuable.
Yeah, it is. It's and it's also a very it's tricky in so many ways. So the math side of it is pretty easy. The structure side of it is honestly pretty easy, right? We can, working with a client and saying, hey, and so for example, this particular client currently has 3 overhead pools, which sounds like a lot for some companies. And we're working to build them into 6 overhead pools plus a material and subcontract handling pool. So a pretty complex rate structure, but they really need that complexity because they have such a variety of products and services that they offer, that right now what's happening is, for example, one of their current pools, one of those overhead pools, I think has 3 or 4 kind of unique service, and they really deliver services. They really have 3 or 4 unique services within that pool that all have a bunch of indirect costs. They all, I should say, different cost drivers, but they're using one rate, right? Because they got one overhead pool, so they're using one rate for all of these services, where in reality they really need, I think it's 3, so they need 3 rates within there. So the way to do that, right, is to break that out, but that also brings about things like, we got to train our employees. We've got to make changes potentially to the accounting system, to the chart of accounts. We've got to restructure, how projects are put together. We've got to communicate this stuff with our client. They have to communicate this with their client and say, hey, we're making this change, and so you're now going to see some changes in the rates. And in fact, that brings about a new kind of issue is, and I said this before when we've done these webinars specifically on indirect rates, if you stop for a moment and just think mathematically, right? So if you've got a pool, right, regardless of the number of overhead pools, but if you've got one overhead pool, so you've got one big number for the numerator, you got one big number for the denominator, and you say, okay, we're going to split this into, multiple pools, whatever that split is. Well, guess what? One, in this case, we're going from 1 to 3 in this particular pool. So when we go from 1 to 3, those individual 3, at least one of those rates is going to go up, right? Because remember, we've got a blended rate here. So one of those rates has to go up and one of the rates has to come down. And at the moment, I don't know what's going to happen with the third one, right? It might be going up or it might be going down depending on what the split is. So the good thing is obviously that the rate that goes down, right, is going to be more attractive, right? We're going to be in a situation where we can be more competitive, so we can win more contracts or win more work even from existing clients who say, hey, your rate's now more attractive. I'm willing to buy more of that service from you. The flip side is, and again, this is where then some of those delicate and difficult conversations to come in is sometimes with those exact customers or even with other customers is to say, hey, the rate for this other service is going to go up. And mathematically, it makes sense. And because what's happened over time is in this blended environment, we've been in a situation where we've effectively been underpricing some services and we've been overpricing other services. And now by breaking this out, we're going to be in a situation where we have better, really best pricing for all of the services, but some prices are going to go up and some prices are going to come down.
That makes a lot of sense. I think that's a really valuable discussion on doing that deeper dive, and communicating to the client is really important, particularly if you're messaging, hey, now we've matured our process, some costs go up, some costs go down. But having that data, those data-driven decisions and information is really where it's at. So thanks everyone for responding to the poll question. The correct answer was A and B, and 87% of the audience got that right.
All right, sounds good. I said there'd be an opportunity to make adjustments to the budget, right? So, I don't want people to go in and think, okay, we set the budget, and unfortunately, I think this does happen, right? People set the budget and say, that's the budget, right? And then you ask to spend money throughout the year, and say, what's the response? No, that's not in the budget. Well, and it may not be, and maybe it never will be. Unfortunately, those things happen, but we can make adjustments, and in fact, we need to make adjustments. And I'm going to talk to you about, again, what those adjustments are and the timing of those adjustments. First and foremost, the first step is that you've got to monitor those rates, and you've got to monitor them monthly, okay? Again, this is a situation, we run into this all the time with clients. We get in there and and I say, what are your actual rates and when's the last time you calculated them? Oh, we calculated them at the end of last year. Okay, well, today is June 16th. Have you not calculated your rates so far this year? Nope. And I'm like, then how do you know what's going on, right? How do you know what to do, right, and what potential changes to make? So you absolutely got to monitor those rates every month. And there are different reasons, right? So some of the reasons are you might have won or lost a major contract or a proposal, right? So think back to how we created. So if right now it's June, and let's say, it's June of 2021, and let's say in the fall of 2020, you took my approach and you did the top down and the bottom up, and you did the marrying together in the hybrid approach, and you developed rates, right? And remember that part of that was you said, hey, we think, based upon outstanding proposals, we're going to win, this X percentage. Well, what happens if you win Y percentage and not X percentage, right? And Y could be smaller or larger than X, right? And either one can have a significant impact on your rates, good or bad, right? And so we need to say, where are we now mid-year basically, and what's going on? We also know, right, there can be unexpected expenses, right? Things last year was a prime example for many companies, right? The pandemic hit, and while certainly some costs were cut, right? So, a lot of travel was cut, a lot of office expenses were cut because people were working from home. But the flip side was, right, maybe for those of you who continued to be in person because that was the nature of what you had to do, right, PPE expenses went up, right? You got companies who were buying types of products they never bought before, right? We never had to do that kind of stuff. You also had companies that all of a sudden last year had to scramble to get, VPNs in place and telecommuting tools, right? And making sure that employees had laptops and they had all of those types of things in order to be able to work remotely and to do so, efficiently and effectively. So, things happen, right? A piece of equipment fails. God forbid you have a flood or a fire or some other kind of disaster, right, that causes a significant impact. Another time that you got to be looking at your rates and what's going on and calculate those rates is if you're putting together a proposal for a major contract. Now, I don't have a magic number. This is Robert's number. This is not in the FAR. It's not in the federal acquisition regulations. There's no statutory requirement. This is just kind of my rough general guide. If you've got a proposal that's otherwise going to have about a 20% or greater impact on your top line revenue, then I would say that's a major proposal. And that's a time where you need to step back and say, we need to recalculate our rates for this particular proposal. Because again, winning that contract, right, would have a significant impact, right? Because remember back to what I've said, just logically about rates. If I can bring in more direct work, generally across the board, I'm going to see my fringe, my overhead, and my G&A rates come down because direct costs make up the primary portion of the base. So if I've got a bigger base, then my rate comes down. So if I've got a project, right, that's going to have a significant top line revenue impact, then I can expect that it's also going to have, a decent impact on cost of goods sold or direct costs. And so those rates are going to come down and I need to be able to adjust those appropriately. Now, when do I make adjustments? So if you're monitoring monthly, and you're watching those trends to see, what was our budget, where are we year to date? Obviously, investigating variances, why is there a difference? Are we going to get back on track? What would it take to get back on track? What we tell people, again, these are just rough general guides. Again, I would say that, if you got to February and all of a sudden you won or lost a major proposal or contract, don't wait until the end of the quarter. Don't wait till mid-year on some of these things to make changes, right? If you've had a significant impact of something in February, make an adjustment in February. Again, the general guides here are monitor them monthly, and then we tell people to adjust the budgets and the spending quarterly. So this means things like making within the pool adjustments, right? So that might be, for example, an overhead. Maybe we had an expense that was unexpected, or it cost more than what our budget or what our estimated cost was. So maybe we knew we were going to replace some equipment, and then we discovered it cost a lot more to do so than what we had budgeted for, right? But maybe what I do is I go within that pool and say, okay, is there somewhere else within overhead that I can make a line item adjustment so that my rates still overall stay in line with where they need to be? I might need to make an inter-pool or between pool adjustment, right? So that might be a situation where I say, I had an overage and overhead. Can I make an adjustment maybe in fringe or G&A that brings my overall multiplier, right? So remember that particularly for labor, we've got a multiplier that includes fringe and overhead and G&A. So if I see my overhead rate going up, is there something that maybe will bring my fringe and or my G&A rate back down so that my total multiplier going through still comes out to where I need it to be, right? So that might allow me to do that through an interpool adjustment. The other thing is that, I just make changes to what we're spending, right? We might say, hey, you know what? We had this in the budget and now we're going to put it on a pause, or we're going to come back and say, we'll reevaluate that later, or we're just going to pull it. We're just going to say, you know what? We're just going to pull that out of the budget for this year. The piece of equipment we have, we can do a little bit of maintenance and repair on it, and we'll get it to the end of the year. And for next year's budget, we'll bring it back in and try to replace that piece of equipment next year, as an example. We internally had a kind of a perfect example of this. While I'm generally pleased that we were not significantly impacted by COVID last year, like many businesses, we did have an impact from COVID. And we had to make some adjustments, and I had to say, you know what, we're going to, pause a couple of these items. We'll revisit them at the end of the year and see where we end up, right? If we're in a spot as we get close to the end of the year that we can, get back on track, then we'll do so. Otherwise, we're going to make this at least temporary adjustment, so that we stay where we need to be. A quick polling question, please, Liz.
All right, very good. This is polling question number 4. And the question is, rates should be monitored how frequently? Weekly, monthly, quarterly, or annually? Jenny, you had surfaced Raymond's question about ODC, the other direct rates, and he had a follow-up question asking if the other direct rates category has material categories in it, does it make sense to budget for those line items separately? And Robert, I think that the answer to that would definitely be yes. Do you kind of have a threshold for grouping costs and expenses together versus reporting them separately?
That's a good question. I don't know that I have a dollar threshold. Again, it would really come back to, for me, the nature of the expense, right? So if I look at my 5 primary cost elements, right? Labor is pretty clear, right? I'm paying an employee, and specifically here, when we talk about labor, we are talking about direct labor, right? Our employees. Travel is pretty clear. I know that this is a travel related expense, right? So we know hotels, airfare, rental cars, gas, those kinds of things are pretty clear. Material, I would say, is generally pretty clear. So to me, material, and I guess this might be where it gets a little dicey, right? Because material, again, like I know, hey, whatever it is, right? We've got a client again that sells high-end electronics, and they buy a bunch of servers and other stuff that become part of the product that they sell, right? So that's a clearly identified material item that's on the bill of material. That would all be material stuff. Subcontractors, again, hey, I know I'm going to sub out a portion of this work, right? To be further clear, when we're talking about subcontractors, even though we might be buying from them or they're providing as part of their subcontract, maybe they're providing and invoicing us for labor and travel and materials. Potentially, maybe they've even got subcontractors as well. For my purposes, that's all just subcontractor, right? So let me be clear. I do not take a subcontractor's invoice that has labor, travel, materials, and then further code that into mine. No. Those labor, travel, material, subcontractor, ODCs are my level, and then the subcontractors all roll up. Now, that said, under subcontractors, you could, in theory, break that out if you wanted to, but it still remains part of subcontractors. Back to the main question here, though, again, those types of expenses are usually pretty clear and identifiable. The ODCs are things that I can't predict, right? So, for example, we know, and I forget the exact number, but if an employee, as it relates to the FAR at least, we know that if an employee is on travel more than 7 days, they are allowed to expense laundry services as an example, right? If it's less than 7 days, no, but if it's more than 7 days, we allow the employee to expense laundry services, right? They got to wash their clothes and be ready to go to work the next week. Those are types of things that, I would put into an ODC. It's something that's not clearly and easily identifiable to one of the other categories.
Very good. Well, thanks for diving into those details a little bit further. And we've closed the poll question, and the results are concentrated most heavily with monthly. 54% of the audience responded monthly. 29% responded quarterly, and then we had a few people who selected annual and a few who selected weekly. So, Robert, can you remind us, this seems like an important point, how frequently you recommend monitoring those rates?
Yeah, so again, we recommend that you're calculating and monitoring the rates monthly. I mean, obviously at the end of the year, you will have calculated them annually, but what we're talking about is monthly. You'll make adjustments or internal spending changes quarterly. And here in a moment, we're going to talk about the changes that you would make semi-annually or annually. So the correct answer is B, Bravo, for monthly. All right, continuing on, we recommend that you adjust billing rates semi-annually. Again, this is a rough guide. If you had that situation where you won or lost a major contract in February or May, don't wait, right? Get those billing rates updated immediately. The reason for that, and again, so let me pause actually and say, the reason we say semi-annually is that, by the middle of the year, we usually have a good sense, right? We've got 6 months, we've got half of the year behind us, so we got good 6 months of good data, and we usually have a pretty good sense of what's happening the second half of the year, right? We know we're on target, we're off target, we've got updates on those proposals. Hey, one of them, got pulled in, and one of them got pushed out, whatever the case may be. We got a good sense halfway through the year what's happening. And that's why we generally recommend that semi-annually is the time to do that. Semi-annually, again, is where you would adjust billing rates for the situation that if you continued on at your current actual rates, you would end up either significantly underbilling or significantly overbilling the government, right? That's the situation that you want to avoid, right? You're never going to hit the target dead on, but you want to make sure that you never significantly overbill or significantly underbill the government. Now, you will make these billing rate adjustments on a contract by contract basis, right? Every contract stands alone. Every contract is going to have different billing rates because it got awarded at a different time. We use different proposal rates for it. We negotiated different rates. There are different factors that come into play. And what I always remind people is if you had 5 contracts, you'd have 5 different sets of billing rates, right? That's just what's going to happen in life because they all got awarded differently. We negotiated different rates for different reasons. There are a number of factors that come into play. The trick, and this is where it gets a little interesting, and I've got some Excel sheets to show you. You can download the presentation. In fact, if you guys send me an email, I will send you, and we'll get our email address up here in a little bit. I will send you the Excel file that I used to develop this scenario so you can kind of see. But what you need to do is calculate effective billing rates for the remainder of the year, right? Because what you need to do is bridge the gap between what you've already billed and what you need to bill by the end of the year. Your actual rates, remember, are based on the enterprise, and the effective rate is going to be calculated again on a contract by contract basis because I have to consider contract by contract, how much have I already invoiced on that contract to date, and what do I expect I need to invoice by the end of the year, and then what's the difference? This means, for example, that if I had 5 cost type contracts, I would likely or potentially need to generate 5 different estimated, or really what I'm calling here effective billing rates, right? Because it's a contract by contract basis, so that I get that individual contract closer to the target. I never want to be in a situation where I've significantly underbilled or significantly overbilled the government. Remember that if you've underbilled the government and you submit your incurred cost proposal at the end of the year, you get final approved rates, and let's say it comes out and on that particular contract, you've underbilled the government by $100,000, and you contact the contracting officer and say, look, I've underbilled you by $100,000, I've got a claim. And the contractor says, you know what? Or I'm sorry, the contracting officer says, you know what? You have a legitimate claim. Guess what? Contract closed, or I've already allocated all the budget. The program is already at budget or over budget. I don't have any more money to give you. Yep, you got a valid claim, but I got no money, right? So that's a bad situation, and you don't want to be where you've significantly underbilled the government. Now, if you've significantly overbilled the government, right? So your billing rates were higher than your actual rates, then you get to the end of the year, and guess what? If that's the case and you finalize the rates and that information goes to the contracting officer, then they're going to send you a demand letter and essentially stand there with their hand out and say, you owe me whatever, you owe me $100,000, you billed me in excess of your actual rates, I've already given you that money, you need to give me the money back. That gets a little more problematic if during the incurred cost audit, they determined that there were unallowable costs or other adjustments to those rates, and you had a situation where now you potentially also have penalties and interest on top of the amount of money that you've overbilled the government, right? So very tricky situation there. All right, I've got some examples again here in some PowerPoint, or on the PowerPoint, some samples that I pulled in from Excel. So this first slide shows my billing rates on a particular contract, right? This is just an example. And so the middle portion there shows what I've invoiced to date based upon those billing rates. So that's actual information in the middle. The bottom section shows what my estimated invoiced amounts will be at the end of the year using those billing rates, right? So what I've done is to say, here's my actual cost to date. I'm adding in my estimated additional cost through the end of the year. And I'm saying that with that, at my billing rates, what would I have billed the customer at the end of the year? And in this case, that's $668,000. This next slide says, what are my actual dates year, or I'm sorry, my actual rates year to date? Again, the middle portion is actual cost. So it says, here's my actual direct labor, material, et cetera. Here's what I've already invoiced the customer for the end of the year. With my budgeted numbers at completion, right? My estimate at completion for the end of the year. If I invoice that at the actual projected rates, I should invoice the customer $634,000. So I've got a slide here. This one's a little smaller, I apologize, but on the left again is my estimated cost at the end of the year with estimated invoicing at my current billing rates. On the right are the same estimated cost using my actual rates at the end of the year. And you can see that if I continue on this path, I'm going to be in a situation where I have overbilled the government about $34,000, right? And that may or may not be a significant amount of money, but I have an opportunity to fix that so that I don't overbill the government by $34,000. And the way that I do that is I'm going to have to calculate on this particular contract some effective billing rates. And the way I do that, again, let me back up, is I'm going to calculate the variance between what I will have billed at the billing rate. Or I'm sorry, I'd calculate that by looking at what I've already billed, my year-to-date actual invoices, compared to what I should bill based upon my actual rates. And then I back into an effective billing rate for fringe overhead and G&A. And that effective rate is what I'm going to use for billing purposes for the second half of the year, okay? This chart is really small. This is why I said, like, download it, send me an email so you can open up and kind of see it. The arrows are there to show you the top left, again, as a reminder, this is what I've invoiced to date based upon my billing rates. The bottom right is what I should invoice at the end of the year based upon my actual rates. I've got a variance, which is now the bottom left. And that bottom left says that in order to bill the remaining $264,000, I need to use those effective billing rates at the very bottom to get there, okay? A little confusing, hope that makes sense. The thing to keep in mind is that you don't want to adjust the billing rates to what your new actual rates are, right? Because if I did that, I would still be in a situation where I would end up overbilling the government because I've already overbilled the government in the first half of the year. So even if I change to the actual rates for the second half of the year, I've already overbilled the first half of the year. So even when combined, I'm still going to have overbilled for the entire year. And the only way to do that is to, and I hate to call them a dummy rate, that's why I call them an effective rate, that's that bridge between those for the remainder of the year. All right, Liz, another polling question, please.
All right, sounds good. We're on to the fifth polling question. And the next one is, which should be adjusted semi-annually?
I guess, Liz, I'll ask you, does my explanation of those effective billing rates, does that make sense to you?
Yeah, I think that does. The concept is a little bit newer to me because I have not worked in governmental accounting. So I've done a lot of budgeting myself, but having the billing rate is a little bit of a newer concept to me, but I think that you had a good explanation of it. And for those who are in the audience who are working with effective rates, why don't you just quick send us a note and let us know if that lines up with how you think about it, or if it's something that maybe you have a different way of thinking about it that would be interesting to hear. So that's a good question, Robert. We're going to close this down. It looks like half of the audience say all of the above, and 40% of the audience responded billing rate.
All right, so the correct answer here, which should be adjusted semi-annually, we were specifically talking about billing rates, right? Now, fringe and overhead are part of your billing rates, all right, to go into it, but it's the correct answer is A, alpha, your billing rates are what you should adjust on a semi-annual basis.
Just real quick as we move on, Christine says she gets it. She equates it to taxes and estimated tax payments. So that seems like maybe a neat way to think about it for those of us who are just becoming acclimated more to the concept of rates.
Yeah, that is a good analogy. I'll try to remember that's good, right? Because if you're working with your tax preparer mid-year and you're saying, hey, I made more or made less money, right, than what we predicted at the end of last year, right? So at the end of the year, right, your tax preparer comes and says, hey, based upon what you did this past year, you need to make X dollars of estimated payments in the upcoming year, right? And hopefully you're going back to that tax preparer mid-year, quarterly, whatever, and saying, mid-year, and you say, wait a minute, we're doing better or we're doing worse than what we thought we are. We've already made X dollars of estimated payments. So now what do I need to make, right? What's the Y number for the remainder of the year so that I'm on target to where I need to be? So same basic concept. All right, let's talk about some budgeting best practices. Again, I know we've got some good comments and questions. Get those in the panel here. We'll have a few minutes to go over those. My best practices for you, and again, hopefully, those of you that are online with us today that maybe aren't government contractors or don't deal with that, hopefully you're still walking away with some really good general ideas. One here is to have a budget, to have a template for your budget. In this case, again, for my government contractors, it's an Excel workbook with tabs where, and again, we like this tab approach because it's easier to put it into bite-sized chunks. The other reason that the tab approach really works is that, for example, a lot of your fringe costs, certainly accountants are part of that, but somebody in HR is going to help you, right? HR is going to say, here are the new rates for health, dental, vision, blah, 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 right? They're going to know what those kinds of things are. HR is going to validate which employees are in which of the, most companies have a tiered approach to paid off, right? So how many of my employees are tripping over, for example, this year, and they're moving into that next tier, right? What is the effect going to be? So what's the nice is that, and again, same concept for overhead, especially if you had either multiple overheads or even if you had multiple departments that rolled up into a single overhead, you could have a tab by department. Then you can share, that tab, in a new workbook with somebody, right? That budget owner, they can review it, they can give their input, and then you can easily pull that tab back into your workbook, right? Because you've got a nice template. So templates are really, really helpful, and again, especially when you've got like this tabular approach. I said that we have, this a concept for dealing with fringe costs and labor costs. So we have a full template available for government contractors. Again, when I get the email address here in a little bit, you guys can send us an email. We're happy to send you a copy of that template for free. And what you'll see in there is there's a tab called labor and related costs. And the concept here, now I've only got one line item in for Sam, but the concept is that I put the employee's name, I put their labor category, I put their salary. I can build this off of either percentage of hours or actual hours, so I have, I can enter this either way. It's really designed to do whatever you want to do. The way I've got it set up here is for percentage. So what I'm showing is that Sam is about 50% direct in what he does, he or she. Overhead is about 44%, right? So they've got training and supervisory. So it says that this person is a supervisor, so they have some supervisory roles right, that are indirect costs. And again, everybody's going to have a certain amount of that. So even your employee, and I run into this, people that say, well, these employees are 100% direct. And I'm like, no, they're never 100% direct. You have an employee who's a direct employee, but they're always going to have a percentage of their labor that's indirect, right? At the very least, they're going to have paid absences. And I can tell you that auditors and people like me are also going to expect to see a percentage of their time in overhead, because we know there's going to be things like travel, training, I should say, internal meetings, other things that are not a direct expense. So what this template here does is, and obviously, you've got a couple of inputs to this. You can pull historical timekeeping records, especially if you've got employees or labor categories, that you can do some of that analysis and say, on average, this is where these people are. You can put estimates in here, right? If it's a new hire and you say, hey, we think this person is going to be about X percentage of these types of things. This is also set up, I didn't finish populating an example here, but when you see the template, it's set up to calculate those percentages into dollars based upon the salary. You'll also see that there are some columns here for things like health, dental, retirement, any kinds of other, our workers' comp. All of those types of things are either a per employee cost or a percentage cost that's easy to incorporate in here. This is a table in an Excel format. And so what you can then do is have the total row, which you'll see again in the template. And then what's nice is you can link to these total rows elsewhere in your workbook, right? So you've got a column here that now shows all of your direct labor. You can take that total from the bottom, link it to your direct cost tab, and it's in there. Same thing for overhead, same thing for all of your fringe expenses. You can link them to those line items. And then what's nice is, as you're going through and building this up, if you come back in and say, back to my example, that maybe you determine that you've got 3 FTEs, and maybe what you do is you put them in here and you say, these are new hire 1, new hire 2, new hire 3, and and you project this out and say, one version of the budget is 3 new hires, right? What does that impact look like? And then you do a save as, and you do another version of the budget where you say, you know what, we're going to take those 3 FTEs, and we're going to spread that across everybody else, and just bump overtime and see, well, what does that do, right? So we could create 2 versions of the budget this way, and I can make changes. And as long as I'm making changes on this tab and I've got my totals linked, then that information is going to flow elsewhere into the budget, making the project a little easier for you. Start early. Again, for my government contractors, can't stress this enough. Assuming that you're a calendar year company, our general recommendation is to work on those budgets August, September timeframe. We know it's going to take a few weeks to maybe a couple of months. Again, our general guidance is for those cost type contracts where you need to submit updated billing rates to the government to get approval, and so that those billing rates are incorporated by modification into your contract. Best advice, get those submitted by November 1st. Why November 1st? It takes the government time to process these changes and to issue a modification. We're also going into holidays, right? So in general, we all know we lose pretty much a week at Thanksgiving. And as we get into the Christmas and New Year's, we often lose another couple of weeks. People are on vacation, different things happen. It's just slower to get those kinds of things processed. And if you think, hey, I'm going to wait until early mid-December to submit my rates, well, guess what? You may not get a modification until the end of January or February, and now you've been in a situation where you've continued to bill at old rates and not at new rates, and that could potentially further impact your under or overbilling status in the following year. That's why, again, we really try to drive people to get those things in as soon as possible. I've already alluded to this. My phrase is share the budgeting love, right? It's not a task for one person or one department. I think you guys have seen that we need sales, business development, program managers. We need department managers who are usually budget owners, right, for their department. We get input from HR on employee costs, right? Again, new hires. We might need to go to HR and say, hey, we need to hire these 3 new labor categories for this project that we expect we're going to win. we've never had anybody in that labor category, so I don't even know what kind of labor rate to propose, right? That's best for somebody in HR who can do that analysis and say, hey, here's the average of what we think it's going to cost us to hire that kind of person. All right, Liz, another polling question, and I think we got one more after this, if I remember correctly.
We do, yes. Okay, so poll question number 6. Excel workbooks should have tabs for each pool, true or false? All right, we'll leave this open for about 5 more seconds. And as Robert said, this is a perfect time if you have any questions or comments that you'd like to discuss. We have about 5 or 10 minutes and we'd be happy to respond to some of your questions. So go ahead and let us know what they are. We'll close this poll question down. 96% of the audience say true. So thanks for responding.
And that is the correct answer based upon what we've talked about. All right, I think, so I want to jump ahead here, and we've got one more polling question to dive into in a moment. While you get that queued up, I do want to say we have our upcoming GovCon Accounting Summit. This is an opportunity to actually earn up to 21 CPEs. We made a little adjustment to the schedule, so we were able to slide in one more credit. If you attend all 3 days, you can earn up to 21 CPEs. Again, this is all things government contract accounting. So hopefully those of you who are out there and interested in this, check it out. We'd love to have you participate in this. I said I would get our contact info up here. You can follow us on social media. Most importantly, I would say jot down that email address. You know, questions come up later, right? And we all the time get questions from attendees who will email me a week or a month or more later and say, hey, I was on one of your webinars and, you know, we got this question or we got this issue. The other thing I said, I have a budget template that's designed. I mean, if you're a commercial, you could take it and see how it applies, but it's definitely designed for government contractors. If you want a copy of that, you got to shoot me an email. And I guess with that, Liz, if you want to do the last polling question, and then we'll do that Q&A.
Okay, that sounds great. So here is our final polling question. Do you now feel more comfortable with budgeting? We'll give a moment for the responses to come in here. And Robert, I did add your email address into the chat box. So for anyone who wants to copy that, they can do so right out of the chat box. Responses are coming in quickly. We'll close the polling question down in about 5 seconds here. And it looks like we're seeing some great responses. So almost 70% of the audience say yes, they do now feel more comfortable. Almost a third of the audience says yes, it's reaffirmed what I knew. And we have a few folks who would like a deeper dive. So you have Robert's email address. If you want to go into more detail, I'm sure Robert and his team would be happy to do so with you.
All right, so do we have some questions for me?
Definitely seeing some great feedback. And Lori says, thank you for a well-organized webinar. Ray says, fantastic webinar. Jenny, do you have any questions that we could address?
I don't see any in the inbox at this moment.
All right. Robert, when you're working with clients and you're starting off, what are some of the key questions that you receive most commonly?
As it relates to budgets or?
Yes, as it relates to budgeting.
I think that probably the two things that jump out at me, and it's not so much the questions we receive, is that we'll have somebody contact us and they're working on something around rates or on a proposal, and I say, well, where did you get those rates, right? What's your budget? And they go, budget? What do you mean budget? And I'm like, oh, this is going to be a fun conversation. And usually what we find is that different things, right? So we'll come across people, they worked for a government contractor before, they've started their own business, and they knew the rates of their previous employer, and they just use those rates. And I'm like, well, those aren't your rates. They are rates, but they're not your rates, right? They don't necessarily align with what you've done. Or kind of a similar thing, somebody will say, well, I was talking to somebody else and they said I should use 25% for, something. And I'm like, well, again, because somebody pulled a number out of thin air and gave it to you, it's not your rate, right? That's a problem. The other thing that I would say, a couple other thoughts that come to mind, the client is usually the best person to pull together the budgeted information. Now, what I mean by that is, your costs, your labor categories, what your rent is, what material it's going to take, right? And those kinds of things, right? You can pull together those numbers. And in fact, you need to pull together those numbers, right? We can't pull together those details. What we can do is make sure, again, that you've got the proper rate structure. We can make sure that the numbers that you have are going into the correct pool. We can make sure that the math is correct, right? And all of those types of things. We can guide you, again, through the budgeting process, but the actual, pounding the pavement kind of work, unfortunately, that's really got to be the client, because you guys know your business, your costs. We don't know those things. I think that's probably the thing that's most frustrating for some clients. And I had another thought, and it's escaped me at the moment, but maybe it'll come back in a moment.
Well, I think just hearing that it's not uncommon for companies, government contractors, when they're starting out, to struggle with their rate, maybe look outside for something they can use, that it's not a best practice. It doesn't quite fit the purpose of a rate, but knowing that that's common, I think can give some hope to those who are maybe feeling like, hey, we have a rate, but we know that it needs to be maybe separated, as you talked about earlier, Robert, that maybe there's two different product lines or two different offerings that, now it's time to split those out, that this is kind of an ever-evolving process, that organizations, as they grow and mature, continue on this journey. And it's okay if you're not where you want to be. It's just, encouragement to keep moving forward, because everyone has to start somewhere, even if it's not with their own rate.
Yeah. The other thing that I would say, and again, this is probably I remember what I was going to say. This is really the other pain point, is from a rate perspective, it's easy to calculate historical rates. Again, especially for those companies that have been in business for a while, right? I can, and in fact, that's where we always start, is we say, give us your final numbers from last year, and let's calculate what your actual rates were, right? So that we can at least validate that, right? We can validate the structure, we can validate the rates. But the best, and you can use those rates for a proposal going forward. DCAA will accept it, your clients will accept it, but they're not the best rates, right? Because they're last year's rates. They're not that forward looking. And it's this, it really is a struggle to get a lot of clients to create a budget, to look forward, to do that work, because the best rates, right? If I'm going to propose, if I'm putting together a proposal for the future, if I'm putting together billing rates that I'm going to use for next year, well, what are the best rates to use? Forward-looking budgeted rates, right? And so if you're only going to take last year's actual rates and use that for your billing rates this year, again, DCA will accept it. It's fine. I mean, they're not thrilled about it, but it's a rate, and it's better certainly than no rate, and certainly better than some rate you pulled out of thin air. But the problem is it just may not align with what's going to happen this year.
Very good. Well, let's go ahead and talk briefly about the program next month. So July is going to be a busy time for you, Robert. You're back with Incorsa on, I believe, July 20th, talking about automated bookkeeping and outsourced accounting for government contractors. So eager to hear a bit about the automation side of things and how to streamline some processes. And then right after that, as you mentioned, is your summit for government contractors. So Incorsa is really excited to be helping to partner with you to make that possible, to offer CPE credit for the program. And I know that you have been collecting registrations, been working so hard on getting an excellent lineup of speakers. So we definitely would encourage the audience to join us for that. Registration links for both the webinar on July 20th and Left Brain Professional Summit will be available in the follow-up email. And then a few other quick closing reminders. You can access your CPE certificate an hour after the end of the program. And also we'll have the recording uploaded this evening. So if you would like to just take a listen back through or share this with your team, you can definitely do that. And the reference materials are already saved to your Encoursa dashboard. So we really appreciate you joining us today. We'd love to connect with you on LinkedIn. You can also follow us on Twitter and Facebook. I know that Left Brain Professionals maintains an active presence on social media as well. So Robert, thanks for a great presentation today. And thank you to the audience for just being very engaged. We appreciate that. And we'll look forward to having you back with us again soon. Until then, take care.